Hello and welcome to another episode of Market Watch. Today we are going to discuss about a few key developments which will have a major bearing on the banking industry in 2018 and beyond. So we invited to a veteran banker in Sri Lanka to our show today. He is Mr. Rajendra Tyagaraja, the Managing Director and Chief Executive Officer of Cargill's Bank Limited. Welcome to the show, Mr. Tyagaraja. Let me first start with the IFRS 9, which I guess will have a major bearing on the banking numbers. So, what is this IFRS 9 at the first place, and how does it impact to the banking numbers going forward?
So, from a global perspective, I think this IFRS 9 phenomenon emanated with banks, the balance sheets having complex derivative instruments in their balance sheets, and there was a international recognition that the way you recognize and report this sort of instruments should have some harmonization, and the concept of fair valuation came in. So it was also understood that at a particular point in time when you measure these instruments, you at a particular point in time you give a fair value for these instruments, and then between 2 points in time, if there is a shift in the fair valuation, either way, the difference is recorded and taken in through the income and expenditure account of a bank. And that's fine. In applying that, in Sri Lankan banking context, there is very little derivatives in a bank's balance sheet. So the most single visible asset class in a bank's balance sheet happens to be the loans and advances category. So there, when we look at this whole process of fair valuation, the philosophy of impairment comes in. That is, you look at a particular loan extended over a period of time, and then you look at the series of cash flows which permeate from that particular instrument, and then to date, what was happening was that the bank was expected to assess the impact of the cash flows based on today, which means using the estimate of actual losses. The major shift which will come from end of this year is that we will have to shift from an actual loss situation to looking at the future and look at what we call an incurred loss basis, which means that you will have to look at two tests when we look at each loan or class of loan. First, you look at if there is the existence of any contractual cash flows for 12 months. And then you look beyond the 12 months over the period of the loan and look at the future and see, is there any incidence of potential loss coming from the cash flows out of this loan because of any internal or external factors, depending on the judgment you place. And depending on that judgment you place, you then compute an amount of impairment which will go through the P&L. Now, what does that mean to a bank as a lending institution, and what does that mean to a common investor or general member of public? Also, from the bank's point of view, gone are the days where they look at time-based provisioning of loans. Now it will be event-based, and the events will not be based on today. It will be based on the judgment the bank places on tomorrow and day after beyond, which means that it has to be a continuous assessment. Which means that there is the possibility of a volatility in the P&L depending on over what period they look at this. So there is going to be, first of all, if they go through this process by the end of this year, because all banks' balance sheets are December based, a one-off adjustment, and thereafter a ongoing annual estimate. Now, I am told the general estimate in the local industry is anything between 30 to 40%. Some people believe as much as 60% of the existing provision base. You will see an incremental provisioning as a one-off adjustment to people's balance sheets, which will go through not the P&L, but it will go through reserves, right, which means that it will have an impact on capital. Saying that it's a one-off base. So for the common person or an investor, the main challenge is going to be how do you interpret judgment? Because no two institutions will probably have the same basis of assumptions for the same borrower. The only way you are going to see the difference is based on the clarity of assumptions and how they are reported in a set of financial statements. My current belief and my concern is that at this particular point in time, banks and perhaps regulators are more preoccupied in trying to understand the philosophy of foreseeable losses or income losses, and probably grappling with the cash flow projections and the model itself, rather than looking at clarity of the actual reporting of assumptions. So my gut feeling is that while there will be some adjustments taking place in the next year or two in balance sheets, it will probably take another anything between 3 to 5 years before there will be a reasonable harmony in different bank balance sheet reports for an investor to be able to look at these assumptions with sufficient clarity and to be able to interpret these assumptions. From a compliance point of view, I think we will get to a stage of unanimity fairly soon, but that will be from a reporting perspective, the numbers, but clarity in clarifying the assumptions which are used to base those calculations, I guess it will take more time to get uniformity in reporting the actual assumptions.
Right. The idea is pretty clear, because if you look at IFRS 9, that brings more prudency in terms of the risk management, but at the same time there would be sort of a volatility in terms amongst the banks how this base is going to be defined. In that context, is it safe to assume, Mr. Tyagaraja, there would be some kind of a volatility in earnings here and there with amongst the different banks?
There will be. The real challenge will be a few things. First of all, for the respective managements of banks itself to continuously improve their own capacity in understanding the shift in philosophy and train not only the finance department people but also the actual business lending officers, because the judgment will be passed on the first line of defense, which is your lending officer. Then the second line will come in terms of risk and finance and compliance. So there is a whole series of education. Then at the board level, audit committees, risk committees, boards, I think gone are the days when you can just sit down and relax and at a meeting and look at a number the way it is normally done, because there is the assumptions will drive the actual clarity and impact on results. I think there will have to be a far greater engagement at board level in challenging these numbers constructively, because at the end of the day, there is a collective responsibility taken by boards in publishing this information for the benefit of shareholders and general public. So I think there is an expectation. for boards themselves to up their own capacity in better understanding this whole phenomenon and preparing themselves and supporting the management in getting to this stage.
Yeah, you mentioned about this one-off impact to the that will be offset through the capital in this particular year. So that's a one-off
Through reserves,
through
yes.
reserves. Yes. With that particular set-off, I think there would be a big impact on the capital adequacy as well. On the other hand, there would be a Basel III new capital requirements come into play. So there's an impact also from the IFRS 9 also. So how does it affect the Basel III adjustments now? Basel III will have also a major bearing on the banking industry. Going forward, how banks may look at this?
So a few things which have been happening in the past up to date will need revisiting. If you look at Sri Lanka's banking industry and you look at the three components of foreign banks, which is a separate specialized thing, I mean they account for less than 10% as market, but you look at the three state banks which still account for around 40%, and then the rest of the private sector. The state banks have been used to reward their single shareholder, the treasury, with exceptionally high dividend payouts, which are not being kept pace with the quality of internal capital regeneration. So if we look at perhaps 2015 and I think up to 16, the traditional payout ratios have been approximating around 75% or 76% of profits available for distribution. And certainly the rate of internal capital generation in these institutions by no way have kept pace with this. So there's going to be a challenge in dividend policies. Even among the private banks, while it has not been as high as 76, Sri Lankan shareholders of banks have been used to receive above average, industry average payouts. That will certainly have to change because if the payout is in excess of internal capital generation, then you are going to see a more increased frequency of cash calls. To what extent is that possible is point one. Secondly, there have been fairly aggressive lending by local lenders in the past few years, and I think that itself will have to be re-questioned in terms of the impact of that against non-performance as well as with the loan growth, with the risk-weighted assets ratios, whether there has to be a greater moderation. Now, if you look at the correlation between what we call Tier 1 capital, which is your share capital, and the rate of loan growths, and if I just look at 2015-16, I think your typical average industry growth was between 18 to 22%. But during that period, the average Tier 1 capital came down from 13% to around 11%, which shows the amount of capital this higher lending has soaked up. So that's point one. In addition to that, we are now seeing a few other things happening where the measurement of risk-weighted assets, the composition is changing. Recently, the local regulator brought in some new directives by saying that any foreign currency lending of banks to even the government, to the state, will now attract a 20% risk weight, which is up to date 0. Secondly, gold lending was rated 0. Now it says if you lend with a loan to value ratio of anything up to 70%, you get hammered with a 20% risk weighting. If it goes beyond that to 100%, your risk weighting will increase from 0 to 100%. So that's going to also, especially for the bigger gold lenders and the guys who have been supporting government borrowing, is going to give a shock to the system in terms of more capital. Then in addition to that, Basel III itself has brought an increased range of capital buffers, where they say that your common equity has to increase from 5% to 7.5%. Then there is another 1.5% additional buffer which they have brought in more recently for the systemically important banks. The 6 large banks with balance sheets of more than 500 billion have an additional buffer.
That's called, I think, capital conversation buffer.
Absolutely. Then you also have, in addition to that, your total capital, originally up to date, which was up to 10%, now goes up to 12.5%, which means it's a 25% increase in absolute terms of capital. So all those pressures certainly will re-examine. I think bank boards will have to re-examine, so will shareholders, in terms of their expectation of dividend payouts, their willingness to come and support the banks on more frequent cash calls, and maybe even re-examine the business model of these banks. In some of the businesses which were thought to be good in the past, is it still viable as we go forward? Now, in terms of the new requirements, there was some skepticism in the past year or so, saying that these banks will find it difficult to raise money. But if you look at what has happened perhaps from the second half of last year to this month, no less than maybe half a dozen big lenders have gone out and raised what we call Basel III compliant debentures and capital, and at least one big bank went and did a rights issue. And my understanding from public available information is that every one of these issues was either fully subscribed or oversubscribed, which means that there is still, despite popular skepticism, there is still sufficient liquidity in the market chasing after this sort of opportunity. So I still believe that Sri Lankan banks, given that they are perceived to be relatively well run, have not faced and probably are not going to face as much as a challenge as what people thought in topping up their capital.
Right. And I'm just thinking with these IFRS 9 changes and again the Basel III capital requirements, the NIMs are going to be further, I would say, narrowed. So in that context, what would be the way forward of the banks? What sort of strategies the banks should deploy in terms of to increase their earnings, etc.?
So I think, see, the banks will certainly have to re-examine their operating model. Legacy banks will naturally have inbuilt cost structures, inbuilt infrastructure, which will be more difficult to unravel and dismantle overnight. So the challenge really is to see how best can you manage your cost structure and also be competitive without passing on any challenges on a shrinking NIM back to the customer. Because today the consumer is very savvy and is very rate conscious and value conscious. If you keep away the corporates and you look at, say, the consumer and the personal banking customer base, I don't think the newer generation, especially the millennial, is too worried about going behind a bank who has been in existence for 100 years. What they want is A, convenience, very good customer experience at an affordable and competitive price, and not get bamboozled with tons of products which banks trying to push at them. They want, maybe 3-4 simple things to do as part of their day-to-day life. Simple products, simple to understand, as easy as possible to onboard, transact, impulse, and get on with it. Now that's which means to a great extent, to what extent are banks able to make use of their data? Banks have the reputation of being the largest repository of information. How do you make use of that information to give the customer a better experience? So that's point one, which is to do with data mining and stuff like that. The second issue is, in addition to that, the role of digital banking. I know that a lot of these banks over the recent past have been coming out a lot with a lot of gimmicks and a lot of gadgets and a lot of paraphernalia with touch points, and saying that we are now doing digital. But let me also make one statement. A lot of that stuff is only one aspect of digital. The true experience would be not just to delight you with what you touch. For the entire experience, going up to the engine which is processing your request to also be seamlessly connected. And if I look at where Sri Lanka is today, at least if I look at the FMCG centric and the retail banking space, we still have a major, in my personal opinion, we still have a major barrier and a disabler which is not contributing to the growth of digital banking. That is the lack of a digital identification. Because we still, see, you have this thing called KYC, which is know your customer. Yeah. But today, we yet don't have the regulators to permit what we call electronic KYC. Right. And if you don't have that, the ability to respond to a consumer's demands within, say, 3 minutes or 5 minutes is a non-starter. Yeah. Now, if you look at South Asia, the best example of a country which has made quantum leaps in digital space and also embraced inclusion is India. And in my humble opinion, it is because of two reasons. One is the birth of the Aadhaar card. Aadhaar is the Indian name for their Indian electronic digital ID card. And secondly, for that gentleman, Nandan Nilekani, the former CEO of current non-executive chairman of Infosys, who at one time went out of Infosys, and he was given the mandate by the Indian government to champion this project. And I know that he went through hell over a number of years, but he eventually had what it took to get it right. And today, because of that ability, you're seeing fintech companies, NBFCs and banks working with industry and are able to give experiences to consumers at speeds which was never thought to be in existence 5 years ago because of this foundation. So I think that is one thing we need to also get right as a nation if we are to go ahead on the digital space.
Right. Finally, Mr. Tyagaraja, now from a macro front, we have seen the central bank surprisingly cut the rates down last monetary policy meeting. At the same time, I think a few days back, Sri Lanka raised $2.5 billion sovereign bond also, and inflation has been hovering at a mid-single digit too. So within these macro indicator, how the banking industry moves in this particular year, what would be the rough lending growth in your head, or etc.?
My gut feeling is I think the policymakers would want to see average lending rate growth less than 20%, I think. And I think that there is some science in this. I recall having engagements with various economists who generally say that the multiplier effect of GDP to lending growth typically in an economy like ours should be between 4 to 5 times, right? So if you see where our GDP growth is today, you can't have 25% loan growth. It just is overheating. So that's one thing which has to be managed. All I would say is while some of the bigger banks will continue to thrive on their fund-based business, I think you will also see the industry giving birth to some challenger banks and new generation NBFCs who will challenge the status quo. And that will not be necessarily through funding business, but through transaction banking and fee base. Because as we as a nation move more away from cash to either plastic or electronic means, again speed, low ticket, large volume business, and the ability to have systems which are agile enough to scale up rapidly at short notice will, I think, be the game changer and the differentiator. Now, in that space as well, a couple of challenges will be as you get onto this challenging and the e-space. Cybersecurity and the concern for cybersecurity will continue to be an increasing problem. And again, it's not about only the management, but also the understanding of bank boards in recognizing the importance of investing in defensive systems. Supporting management will be a necessary thing. Gone are the days where you say you invest today $1 million and for the next 10 years you go to sleep. The life cycle of replacement cycle of technology will be getting shorter by the day. And I think the next thing is while all this takes place, you will see the emergence of new technologies which may currently not be embracing banking systems, but if the regulators don't support, you will see non-banking institutions getting into this space. And one such technology which is already making headway in other parts of South Asia and Southeast Asia is blockchain, right? And I know that India has embraced it to some extent. Singapore is very much into it, so as Hong Kong. We in Sri Lanka are a much smaller economy. Because of that, I think we have a tremendous opportunity to transplant that technology much faster than a larger nation. So there is an opportunity, but also a challenge for the regulators to improve their understanding in this space, work with the industry and see how can you use this new technology as a competitive tool to attract business into Sri Lanka.
Right. With that, we conclude our discussion. Mr. Jagaraja, thank you so much for your valuable comments. So thank you so much for our viewers at home. See you next time with Market Watch.